You've probably heard the word K-shape recovery lately. There's actually 4 recovery shapes, V, U, L, and K, and we're going to break them all down in order. Let's start with the one everyone hopes for, which is the V-shaped recovery. Picture the chart. It's a sharp drop down and a sharp move back up like a clean V. The economy falls fast, but it also rebounds fast, kind of like what we saw in April. Markets sell off hard, policy kicks in, confidence return, and prices rip higher. In a V-shaped recovery, people who held through the pain or bought near the bottom look like geniuses. The message here is the damage was scary but temporary. Now compare that to a U-shaped recovery. It's the same idea. We fall and then eventually we get back up, but instead of bouncing back right away, the economy drags along the bottom for a while. Think of it like sitting in a waiting room. Unemployment stays elevated, growth is sluggish, business and consumers are cautious, markets might chop sideways for months or even years before the trend clearly returns higher. In a U-shape, timing matters more. If you assume a quick V and go all in too early, that long flat bottom can test your patience and your risk management. Then there's the ugly one, the L-shaped recovery. Picture the chart again, sharp drop down and then basically flat. That's the L. The economy takes a big hit and instead of bouncing, it just kind of grinds sideways at a lower level. Growth is weak, investment is weak, confidence is weak. In an L shape, it feels like old highs can be distant memories. Sometimes policy mistakes, structural problems, or huge debt loads keep things from snapping back the way people expect. Finally, we have the K-shaped recovery. Instead of one line, imagine 2 lines forming a K. After the crash, one line goes up and the other line goes down. That's what happens when parts of the economy recover or even boom while other parts continue to struggle. Higher income households, big tech companies, or asset owners might see their wealth and stock prices surge. At the same time, lower income workers, small businesses, or certain sectors fall behind and never fully recover. So a K-shaped recovery isn't about GDP or the S&P 500. It's about who is actually doing well. One group is climbing the upper leg of the K and another group is stuck on the lower leg. Why does any of this matter if you're just trying to be an investor? Because the shape of the recovery changes. How fast earnings are coming back, what sectors lead, and how aggressive you want to be with your risk. A V-shape, momentum and growth names might rip higher as optimism returns quickly. In a U-shape, dividend payers and quality balance sheets can help you survive that long, boring middle. In an L-shape, it might be more about defense, cash flow, and being extremely selective. And in a K-shape, it's about recognizing which parts of the market are on the winning leg and which ones are not. Key takeaway here is don't just listen to the headline that says recovery. Ask, what shape is it? Who's actually benefiting? How fast? And what does it mean for the risk you're taking? If this video helped you understand the alphabet soup of recoveries, save this video and share it with someone who only thinks in terms of crash or rally. Hit like and follow for more breakdowns like this so you can actually understand what the market is doing and not just react to the noise. This is not financial advice. Always do your own research before investing.